All right, so welcome to the show today, everyone. Thanks for joining me. My name is Darcy Ungaro, and I'm delighted to be in the presence of Greg Fleming. How are you, Greg?
Hi, Darcy. Well, thanks, and thanks for the invitation.
No problem, no problem. So you're the head of the Global Diversified Funds at Salt Asset Management. Hopefully, I got that right. Give us a little bit of a background as to who you are, where you came from, and why you do what you do.
It's really a roundabout story in a way because I started off my career in Wellington 25 years ago and was an investment manager in a multi-asset team there. Then in the year 2000, I had an opportunity to go overseas and work in industrial economics. So I worked in International Trade Association management in Switzerland. In the mid 2000s, 2006, I took up a job in Zurich in the investment committee with Credit Suisse Private Bank. And that was also multi-sector, multi-asset, multi-currency, looking for strategies between regions for a wide variety of private banking clients. Came back to New Zealand in 2015, again stuck with multi-asset, and this is where I'm now in Auckland for almost 2 years. It's a fascinating field, multi-asset, because it ties up all the disciplines in capital market study, economics, economic history, geopolitics. So it's actually quite riveting. You're really close to the coalface of what's happening in the world.
When you say multi-asset, is that kind of what you mean? Is that it's just really all the asset classes that are out there and you're looking at all of the factors that can influence them? Is that right?
Yes. In the investment world, you get either sector specialists who might be equities, shares, New Zealand, Australia, global, or bond specialists or property specialists. But there's a small sub-tribe who call themselves multi-asset or multi-sector. And they're the ones that are generalists and they know the features of all those asset classes and how they work together.
Right now in the environment where we're living through an extremely dynamic period of time where there are multiple cross currents of change happening and transformation. I guess I probably answered my question, right? Like from an
Mm-hmm.
active manager's perspective, how do you feel going into this environment right now? Do you feel
Yeah.
fairly equipped to be able to deliver out performance to your investors?
I think we are very well equipped as active managers. I mean, there was a sleepy old decade up until 2020 where passive had great advantages because there were generally beneficial conditions prevailing. Things were predictable, inflation was low and managed. Central banks got involved every time there was a crisis, and so the cost efficiencies embedded in passive, ruled for a while. However, things can change very rapidly. Now, I should make the point, passive can really only promise the long-term returns characteristics of an asset class, because that's what you're riding when you take a passive exposure. The 7 to 10 year time frame, classic average return over those years. It's a long time to wait for some investors, especially if they're close to retirement or need their cash in the interim. So active managers, quite by contrast, can dip in and out and change things quite rapidly where they need to benefit the client's cash flow and capital growth requirements.
So if we kind of think about the environment and kind of what you were just touching on right there is the concept that all boats rise on an incoming tide. And that was potentially true up until maybe a couple of years ago. And now it feels like either the tide is going out or at the very least, there's a hell of a storm going on, which kind of
Yeah.
masks which way the tide is going. I guess I just want to maybe dig a little bit deeper into just how the market, like what actually is inside of the market that we've been investing in, say even like over the
Mm,
last 40 years, specifically as it relates
mm.
to bonds, because in the early 80s when interest rates were super high, I guess we've been kind of riding this trend downwards in terms of interest rates, and that has had the effect of creating like a bit of a bond bubble.
It was a 40-year bull market in the bonds, and it created a mindset that there was a kind of win-win that bonds, because they had sovereign backing often, and therefore the ability to raise taxes underpinned those bonds' ability to pay their coupons, that
Hmm.
it was a risk-free asset class. And a lot of economic theory and econometric theory developed using this risk-free assumption that certain kinds of government bonds could be treated as having zero risk whatsoever. Now, if you introduce those into portfolios and run the statistics, it has a very beneficial optic because it can use to dilute the apparent volatility and expected risk level of that portfolio. Now what's happened though, we're in a different regime. Regimes change quite quickly and bonds are adding to the volatility of a portfolio. And no one's quite sure how long this will last.
Right. So when you say it's adding to the volatility, is that just because it's kind of now moving in the same direction as the equities?
Mm.
Whereas in the past, the theory went anyway that in good times, shares or equities performed well when bonds kind of lagged behind. And then in really dark times, equities fell and then bonds created that floor. Is that kind of the idea?
That is most of the idea, absolutely. The idea being that you had an inverse relationship between the two. You were mainly building your wealth through the equity component of the portfolio over the decades, but there'd be interim periods of shock that they wouldn't last more than perhaps a year, like the GFC. That was the assumption before the central banks got involved. And those were the times when bonds really, really outperformed and saved the portfolio's worth from the drawdown that had happened in the equity sleeve. The other
Sure.
aspect, though, is that the volatility comes from measures of the price movements of all the securities day to day, week to week, month to month. Bonds generally, historically, move a lot less in price from day to day. So those smaller movements in percentage terms lower the overall volatility measure in the portfolio.
Sure. So I think you mentioned this already, but kind of by default, those that would allocate towards bond funds, they would be what operating historically anyway, operating under the assumption that the Fed, the US Fed or Reserve Bank, central banks are always kind of there as a
Mm,
backstop. So that really it's kind of like a proxy for that risk free rate of return to insert.
yes.
Is that correct? And if so, is that now broken, that assumption?
It's under stress, I would say, rather than fully broken. There's been a lot of evidence in the last 6 months that the Fed and other central banks are not prepared to play insurance company to all the assets in the world forever, because there's moral hazard in that. If central banks underwrite credit risk, then credit risk gets underpriced in the market. So to unpack that statement, there
Mm,
was a time when central banks would buy bonds almost regardless of their credit rating, just to keep liquidity and keep confidence going in the markets. But by doing that, they're kind of robbing those investors out there who have made active decisions on which bonds are worth buying and which aren't, which are
mm.
dangerous and which are safe. And the Federal Reserve or the RBNZ or whatever it happens to be is preempting a decision making process that's better sort of left with the investor.
All right. And so as we get into this a little bit more and peel back the onion layers, we probably should kind of tackle the question just for those, and I'll probably put myself in this category as well. Those that often kind of trip over the mental gymnastics that you have to go through
Mm,
to understand how the value of bonds are determined, and
mm,
things like what's the difference between investing in an individual bond versus a bond fund. So, just to break it down in simplistic terms, for those of us still kind of getting our head around this, can you
mm.
describe what a bond is and what influences the price?
A bond in the basic sovereign sense, I won't immediately talk about corporate bonds. A bond is a loan. It's a form of loan. So if you are buying the government bond, you are making a loan to the government of the nation that issued the bond. It has a term, that loan. It can be as short as 3 months or as long as 30 years, in some countries even longer. Now, when you financing the government in the bond market, you go to a primary auction. The government bids, essentially puts up a whole lot of bonds on offer. We had one in New Zealand this week, and investors will rush in and say, I will pay this for that particular bond. Then the government allocates the bonds according to the level of demand. In recent years, those auctions have been massively oversubscribed by investors, always far more interest than bonds available to satisfy the demand. So that allows the bonds to sell at a discount, so the yield will go down because when the auction clears, there's so much demand for those bonds, the government can actually obtain financing relatively cheaply in terms of the ongoing interest burden that they have to pay to keep their finances in order. It's the Treasury departments or the treasuries of governments that run these operations. They take the government's budgets into account, but they'll also take off-balance sheet items that the government also has to have security against. So it's a very complex process, but once issued, they then start trading in a secondary market, and that's where most of the fund managers are active, where they buy and sell bonds to one another. And that's where judgment call on the direction of interest rates and the direction of inflation becomes important as to whether you're getting a good purchase or a regrettable purchase.
So the general sort of vibe here is that in that secondary market, as fund managers or other groups of investors are buying off each other, the amount that they're willing to pay for the bonds is determined around that choice that they have, right? Like they could either invest over here because the market is now giving us better interest rates. Perhaps the central bank has increased the official cash rate and now interest rates are higher. So we're not going to put our money over here, which then makes the bonds who have a fixed coupon payment or interest rate look relatively less attractive. And that's why the value of bonds go down, generally speaking, in a higher interest rate environment. Have I got that right?
Yep. When you're looking at assessing a bond to buy, the two big risks are what they call the duration risk, which is that during the length of holding that bond, if you held it through to a 10-year maturity, inflation might be higher in the future than it is currently. So you've got to have a price mechanism to reflect the risk of higher inflation over time. And the second risk really is credit risk. So you have to assess whether the issuing authority, government, company, whatever it is at any stage likely to default or defer payments of the coupons. If there's any probability of that, the bond should sell for cheaper with a higher yield than it otherwise would.
I get it. Okay. And so that's why it's kind of relevant, isn't it, to understand what central banks are doing, right? Because
Yeah.
the duration risk and the credit risk, those two things are directly connected to that, right? Like if inflation expectations change, then that will change the direction of where interest rates will go and how long they'll stay there. So that's important, with the bond values potentially going down and staying down for a while. And then there's the credit risk element where they're now a little less willing to be the underwriter. They don't want to contribute towards that moral risk where active bond investors are kind of not really being rewarded for their work, right?
That's right. And that's where inflation is so high that the government is quite likely to restructure the debt at some point. It's not possible then for the government to know how much it's going to have to pay in advance to borrow that money. And that can sort of deteriorate even further into a kind of creditor committee situation where the debt gets renegotiated and haircuts are applied to the value of the debt. Now, emerging market bonds are not well known in New Zealand. They're a big investment asset class in the Northern Hemisphere because the yields have historically been really, really juicy. But you've got to be very, very skilled and active in that area because it happens from time to time that the default probability, the credit risk, goes through the roof. And it can be a little unpredictable what might trigger that. It might be an invasion. It might be, a political, like an election result, many, many things. If you look at Brazil, we've got the second round of the presidential election coming up this weekend there. If there were an upset there, that will have serious ramifications in the bond markets for Brazilian bonds. The more unorthodox bond assets you hold, the more active and the more scrupulous you have to be about investigating all the risks that can affect the value of the bond.
And then just, I guess, going back to the bond, what it is, how it works, what influence the prices. When we talk about bond funds, like as an everyday investor, I could just jump on to my shares account or my Hatch account and I could buy some bond funds if I wanted to.
Yeah.
And what am I doing by doing that? Because it's not just one bond. What do I look for, and how is that structured as a collection of a bunch of different bonds with all sorts of different characteristics?
Yes, there are so many bonds on issue in the world. And the world bond markets are much larger than the world equity markets, and there are many more individual listings. So what's happened over the years is that indexes have been constructed. The original one was the Lehman's Ag. Lehman Brothers had this, and the Salomon Brothers also had an aggregate index that was widely followed. It's now become Bloomberg Barclays Ag. But these indices hold thousands and thousands of individual bonds, and an individual investor could in no chance replicate that. So in a fund, the manager will have chosen how closely they want to track that bond index, and they'll have built up the underlying assets to do so. Or they may say, actually, that index contains a school of bond that we don't have interest in. It might be, say, Chinese sovereigns or something like that, and they'll exclude that part of the bond universe from what their fund will hold. And they'll be clear about that in the issue documents.
And so when it, like, just practically the mechanics of what happens inside of that, obviously when you're buying one bond, it reaches a point in maturity where the principal is returned back. When you have a bond fund, presumably you have a manager who's constantly rolling them over and replacing them. Is that kind of how it works?
Absolutely right, because the individual doing the bond ladder approach of running your own set of individual maturities, they get involved quickly in quite complicated scheduling mathematics and such like. When you buy a bond fund, that's all built into the fund. It's presumed that the manager just rolls forward rather than ever intends to cash the bond in at maturity. They will roll forward into the next issue.
So let's talk about this concept called the 60-40 portfolio. This is a term that people might have heard about. They might be very, very aware of what it is, and the 70-30, 80-20, 90-10, all that sort of stuff. But what is the nomenclature around just what that means? And because obviously that means something. So why don't you go first and tell us what that means before I talk it up?
Sure. Okay. Now, what you're describing there is the risk frontier. We should, always remember that this is a hypothesis. It's based on some observations, but it's also quite theoretical, and it doesn't always correlate to things happening in the real world. But as you see there on that curve, there is a return expectation going up the vertical axis and a volatility expectation going along the horizontal axis. And if you were to draw a diagonal tangent that goes up and intersects with the frontier, in theory, in the efficient markets hypothesis and capital markets pricing models, you can find a point exactly, that's the line, where you're getting the maximum expected return for the minimum expected risk. And portfolio constructors, strategists, asset allocators are always bearing in mind where they are on this frontier when they're dealing with structuring a client's portfolio. It's pretty much so they can say, for this level of volatility, you will be expecting to be rewarded by this level of return on average over time, not in any 1 year. It's usually a medium to long-term assumption. So it can run up to 10 to 15 years that this frontier will be functional.
Right. But the idea is that for the given unit of risk that an investor is comfortable with accepting, this is a picture of how you can maximize that blend of, say, bonds and equities to get that sweet spot, right?
Yep, quite right. Yep. And I should also add that risk in this model is taken as a standard deviation. So it doesn't differentiate whether the risk of the market is up or down. It's just a risk of the size of the market move.
Gotcha.
Which already starts bringing in a problem. Yeah, because investors care less about volatility when the market's going up than they care about it when the market is going down. They're not too worried if their wealth, jumps up jaggedly as long as it's jumping up.
That's right. Yeah, there wasn't too many complaints in following March 2020, was there? There wasn't too many complaints around because everyone was a genius, right? But now we're getting into a more, I guess, normal market where there's uncertainty and probably there's more fundamental drivers pushing things along rather than backstops and exceptions to rules. I think investors probably need to stop, pause, check the assumptions at the door and kind of look at things for what they are, not what they were like in the past. Do you kind of agree that maybe we're at a bit of a turning point in terms of how we think about investing going forward?
I think we are. I think it's because the central banks have finally realized that inflation is still alive. Remember 5 years ago, a lot of commentary was inflation's been defeated for good, and there had been evidence that the downtrend in inflation that had started in the mid-'80s had resulted in a kind of permanent zero inflation environment because of globalization, demographics, the glut of global savings, all of these things. Now, it only took one pandemic, and the effects of one invasion to kind of put that completely, to put paid to that theory. But the problem was that the assumption of low inflation led people into a lot of investment directions that would only work under low inflation. Some institutions are still scrambling to kind of readjust to this. I mean, even the central banks seem to feel that they could stimulate a lot more than they would have done in the past or than would have been deemed prudent, because they thought that inflation didn't have the same transmission mechanism that we'd seen in the 70s, didn't have the same mechanism that we'd seen in the 80s, that there were these other forces in play. So all that time that you mentioned where we were feeling good in the last 3 quarters of the year to 2020 was when liquidity was washing out of central banks. Money was being printed, interest rates being driven to zero, real interest rates well below zero. And that creates this perceived rising tide. But you would have to be naive to have not expected an inflationary aftershock from all that.
So while this kind of new situation is dawning upon us, I guess we're kind of thinking about some of those assumptions and kind of thinking ahead. One of the questions, I guess, would be, well, when it comes to what we were saying before around how portfolios are constructed, where say 60% allocated towards stocks, 40% towards fixed interest for I guess you'd call that a balanced investor. Is that kind of now all up in the air, and people are kind of going, no, we're going to start to wean off of these bonds now, or like how are
Uh,
people interpreting that in your industry?
People are cautious to throw the baby out with the bathwater, so they don't want to abandon something that has got merit, which is diversification from uncorrelated assets. The problem is, are they genuinely uncorrelated? And what we've seen in the bond bear market that has happened since interest rates have been rising right through last year, and certainly as a big part of this year's story, is that a bond bear market then led into an equity bear market, both markets dropping between 15 and 20% in tandem. So you're not getting any benefit from the diversification of either. If you're a bond investor from holding equity, if you're an equity investor from holding bonds, only cash has really diversified risk. So given that people are not that interested in holding cash where the yield is less than inflation, you have to start coming up with some solutions where they feel that they are going to have a protection structure built into the portfolio. So they are rethinking, but they don't want to abandon a basic structure that does have merits over time, which is correlation isn't a free lunch in finance, or a lack of correlation. If you can identify genuinely uncorrelated assets, you're getting something for nothing, which is one of the few occasions that arbitrage doesn't work in international markets.
Yeah, yeah, well said. And I guess I'm just wondering though, like, is it going to be going from a 60-40 to a 60-20 and 20 something else, or is it really a reallocation, redefinition of what would be in the 40?
I think that's a really good question, Darcy. I mean, I like the formulation that you put first, 60 plus 20 something else. I think that's probably where the best research is going at the moment. There are huge parts of the world investing community that have to hold bonds, whether they be long-term pension funds, institutional buyers, even central banks themselves, for reserve management. So there will always be demand for bonds of a certain quality. You can't just say, they've hurt us, so we'll get rid of them. But they can't occupy such a large share of a portfolio as 40%. The yield on them is still insufficient. The real yield after inflation is still insufficient. But the diversification benefit, which was their main value, isn't there anymore. Liquidity has been a plus for bonds too. That's also starting to have some doubts expressed around it. Some patches of quite historically liquid bond markets have shown illiquidity, and trades have taken days to execute in some instances. So some of the historical merits of a large bond allocation have been really drawn into question over the last year.
Okay. Going a little bit further then. So let's just say it's a reallocation of that 40%. All of that was once maybe targeting bonds. Maybe there's some substitutes that now cautiously get inserted without throwing the baby out with the bathwater. We're just going to maybe start experimenting with some other like proxies for what bonds can do, which is like almost guaranteed or fixed cash flow. And like there'll probably still be a little bit of non-correlation going, so that when equities boom, they might be left behind, but when equities fall back, there's probably a lot more of a stable platform. So what could be some of the substitutes that a fund manager could look to insert?
The first option is really the real assets, which are, infrastructure in particular, and commercial real estate, which is internationally a much bigger asset class than we are used to in Australasia, because it's not just about commercial and retail properties. It involves data centers. It involves storage, for example. It's listed assets on and residential developments for small families, for example, rather than just great big parks of apartments, which you sometimes see. Those very, very heterogeneous types of real assets have very good yields, and they have quite stable yields historically. So their yields are, by New Zealand standards, they don't seem super attractive. They can be between 4 and 7%, depending on the underlying asset pool, but they are stable around that level. And that can actually form a very good basis for a portfolio's defensive side. They will be more volatile because listed equities, particularly where they are real estate or infrastructure, will trade up and down. But it's important to remember that the volatility is not necessarily material if you're investing for the yield. As long as you are certain that the volatility isn't indicating major credit problems, it's really kind of not the primary consideration. I worry when people hold illiquid or irregularly revalued assets and claim that it's less volatile, because sometimes it's just concealed volatility. So some of the things which you can introduce into portfolios that in place of the liquid bond markets are very good diversifiers because they're just not revalued very often. Think about a forest, for example. If you go right to the extreme of real alternative assets, you could buy a forest. It does have a cropping yield. You may well get carbon credits from that forest, but you don't always know what that forest is worth from day to day and month to month. So when you're doing your portfolio analytics, you've got to make some assumptions. As a result, the portfolio will look less volatile because you have an irregularly repriced asset in there.
That's interesting. So
Mm.
the forest, I guess that's kind of like almost an example, I guess, of a zero coupon bond, sort of, where you put the money in, you wait for the forest to grow, and you get it back at the end. Maybe you get some carbon credits, though. That's the exception to that.
Yes, that
Um,
is. We've got an
yeah.
exception now with our ETS. But I
Yeah.
mean, even in the carbon markets, there are, there's the carbon fund that we have. There are other ways of accessing uncorrelated assets that are useful on the defensive side. So
Okay.
you can invest in the carbon market itself here and internationally in a way you're exposed to the price of the carbon emission units.
Yeah.
And that has no visible demonstrable correlation to equities or bonds whatsoever. It's in its own world. It relates to regulatory timeframes and to what we've signed up with the United Nations and COP22 and things like that. Mm.
So you're tapping into something that's operating on a different plane, on a different sort of
Yes.
set of realities, and that's kind of what you're trying to do when you're trying to get correlation. But going back to what you're saying around the what investors would look for
Mm.
around like bonds, like one of the
Mhm.
characteristics is cash flow, right? It's
Mm.
cash flow. They want to make sure that they're getting a continual, reliable stream of cash flow.
Yes,
So
inflation protected ideally is the other side. Yeah, the inflation protection is crucial. It's kind of a material if you've got cash flow coming in that's markedly lower than the inflation rate. And that's been the problem over the last couple of years where inflation has outstripped any yield available on a safe asset and even the yield available on some sub-investment grade assets, the old favorite junk bond arena. Their yield has been lower than actual inflation in the US at different
right.
times, which is kind of madness.
Yeah.
But if you're looking for something that has that inflation protection, often you find special features in infrastructure contracts that are inflation linked. So the
Mm,
company that's contracted to provide infrastructure to a government or a city will actually have an escalator clause in their contract whereby their payments go up in line with the rate of inflation. And that's just built into the original contract. It happens because the scale of investment that the infrastructure company has to push in to build something on the scale of a big pipeline or a big desalination plant or a power station or something like that is such that they need to be assured that they're not going to lose money because of inflation if the government does something inflationary. So that's a common feature in the infrastructure space. But you can also find features beyond real assets. There are ways of diversifying into fixed interest areas that are new. And one issue in this area is the whole green bond area. They tend to be issued by supranational institutions. So to put that in layman's language, things that are not governments, but not private sector either, or they're hybrids between government and private sector. So if you think of sort of the Institute for International Finance, which is a World Bank spin-off, And these agencies that traditionally have worked in the developing world, upgrading their social infrastructure and their physical infrastructure, have been the natural first issuers of green bonds. And that example I gave before of a desalination plant is a perfect example. So much of the world has water scarcity at the moment that finding alternative sources of drinking water is crucial, but the technology involved is really expensive. Also, energy transition. If you're a big energy provider and you're aware that your obligations under climate laws are going to become more and more burdensome, what you'll be doing right now is transitioning your generation capacity away from carbon emitting towards sustainable or renewable sources. Now, those companies issue green bonds specifically tagged to a project that takes their generation in that direction and earns merit points for the company concerned as well.
Okay. So there's a lot in this, right?
Mm.
And those merit points is something maybe just to kind of break down a little bit in terms of quantifying it. Because if you were an investor and you're investing in something with a green tinge to it,
Mm.
your your investment return takes on a qualitative piece, right? Like it's not just money coming back to you, it's money and outcomes on the other end of it. And
Mm.
the way that that gets translated into a return for investors going through fund managers, how does that actually work? Like if I'm
Mm.
investing in a fund and there's some green bond exposure, am I correct in assuming that, hey, the returns may be lower, but I need to recalibrate what my definition of a return is, i.e., I need to be happy that the planet's being better off?
You can see it that way. I mean, I think the green bond issuers have been able to issue with a lower yield than other issuers, other corporate issuers, because that's partly because they're green, but it's also partly because they're backed by quite large international institutions.
Mm,
So in those instances, you're not sacrificing return. It's more that the credit quality of the issuer way back up the chain is extremely good, and you're benefiting from the credit quality of the parent organization.
there you go.
So yeah, it's a little bit deceptive.
Mm,
But then again, once those bonds are in the market, if all of a sudden there's a huge demand for them, you may well be able to sell the bond at a higher price.
yeah.
So you don't have to hold it to maturity. And this is what we have seen in the last 5 years. There are fewer green bonds in the market than people wanting to invest in them. And so they trade at a premium. So the lower yield or the higher price on green bonds has got a lot of different causes. Part of it's just supply and demand, but part of it is the credit quality of the issuer. And part of it is that, as you say, that psychological positive that some people get from greening their portfolio.
So there's a whole range of substitutes, though, right? Like it could be
Yep.
maybe
Could
forestry.
be.
Maybe there's a fund that buys residential property. Maybe there's
Yeah.
commercial property funds. There's green bonds. There's.
Mm.
Can you think of anything else, or is there any other substitutes that you could think of off the top of your head?
You've got to be tolerant of a bit of illiquidity there, you know. So if you're prepared to go into things that aren't market listed, there's a range. There are farmland trusts around the world that buy up really good quality farmland. In New Zealand and South America, and Australia. It's funny, actually, New Zealand hasn't given birth to many of these itself. A lot of them are run out of the UK, strangely enough.
Hmm.
But they have the underlying certainty that people are going to be needing food and good quality food and security of supply. Things that are infrastructure, but the infrastructure you don't see, like the shipping parts of the world. You know, there
Hmm.
are assets in shipping, financing, and insurance provision to logistics companies. You can go down into that slightly esoteric part of the market and get
Hmm.
very, very good yields. In fact, the leasing return on shipping underwriting was the best performing yielder over the last year or two, because so many people needed ships. The price of shipping went through the roof.
Hmm.
There are alternatives, but they become a little bit obscure. You're reliant on the advisor to open the door to those alternatives and show you the place in the portfolio. Also, the scale of things like that in the portfolio will never really be large enough to offset unless you have an amazing sort of Santa's sack of
Yeah.
alternatives in which you might need to have 10 or so
Yeah.
alternative exposures, which you could theoretically build in. So you do need something that is more liquid and more conventional as well.
But is this kind of like a story of how evolution occurs within the financial system, where
Mm.
things kind of grow up, right? Because I'm just guessing
Yeah.
at a certain point, maybe there's more institutional money that starts to look at some of these slightly more nuanced opportunities, and more
Mm,
growth happens because you're lowering the cost of capital towards the part of the world that needs to grow and transform the most. So
mm,
I'm just thinking ahead, like maybe going forward, it's not so much about just being a lazy passive bond investor where you kind of put your
mm.
money in, forget about it, and collect it back at the end with some payments along the way. Maybe we just have to get comfortable with the fact that there's going to be a little bit more work, either by the investor's behalf or from a fund manager, to actually get the return.
Totally get that. What happened in the 8 to 10 years before 2020 is a perverse situation where people were buying bonds for the capital gain and buying equities for the yield, and that was really unsustainable, and yet it was amazingly widespread.
Right.
Um, so now there's no more scope for capital gains from bonds. There have been quite serious capital markdowns in bonds, as I said, minus 15 to 20% in world markets. Even the UK gilt market is off over 25% year to date. You've got to now be very selective about the financing proposition that the bond is linked to. And you can't be lazy, as you said, Darcy.
Right.
Yeah.
So you mentioned that speculative word. So thinking about where interest rates are right now, looking at
Mm,
central banks around the world getting very serious on inflation,
mm,
and maybe this game of chicken really isn't a game of chicken. Maybe it's verging on a head-on collision with the
mm,
reality that, hey, interest rates, they're still going up. And
mm,
I'm just wondering, at some stage, there's probably still got to be a pivot at some stage, maybe when
mm,
things start to break, perhaps. But when that
mm.
happens, are we going to see like a bonds kind of turning into a speculative asset where people want to buy when interest rates feel like they're at the peak, so that they can gain on the underlying increase in the value going up?
Yeah, I mean, that would be the case were it not for the fact that the central banks have also said that they're going to do QT, which is, to buy back, all
Gotcha.
of those bonds that are on their balance sheets as a result of the COVID emergency have to re-enter the market. They don't want to hold on to them. So they are now obliged to sort of stagger out this rolled, maturity or whatever rolling down so that they're not holding so much of the government bonds books on their own balance sheet.
Mm,
Because the central bank financing the government in that way is a sort of a no-no. Were it not for that agenda, and if it was just an economic cycle play, you're absolutely right. People would trade in and out depending on yields going down because the economy is slowing and the bank is pivoting. But at the same time as pivoting and pausing, which I think the central banks probably will, at least over the new year period, they probably should, just to see what impact their tightening to date has had. They're
mm,
meant to be also letting their balance sheets roll down, and the quantitative tightening roll forward. And the
mm,
scale of that could be adding another the estimates are another 1 to 2% to the yields. So we've already had between 1.5 and 2.5% increase in the yields from where they were at the very bottom. If you got on top of that another 1 to 2% in the yield, you'd see a bear market about two-thirds as bad as the one we've already had in bonds. So
right.
they will decide, the central banks will decide. And it's just a shame that market participants are now so beholden to these decisions of central
I know.
banks.
It's not investing anymore. It's about
No,
anticipating what regulators are going to do.
I think they're aware of that, and I'm not sure they're ashamed of it. They should probably be ashamed of it. I'm not sure the feedback mechanisms that get back into the governments that empower the central banks to this degree. But no, I mean, the market is not setting the price in many assets now. They're reacting to an implied central bank guarantee price. And that's why the slightest hint of a pause, in a tightening cycle leads to extreme gains in
Yeah.
interest rate sensitive stocks.
It's so weird, but I guess on one level, you can rage against that and criticize them, as I often
Mm,
do. Uh,
mm.
but then on the other level, there's this sense of financial stability that they need to be maintaining, right? Because if there's disorder in financial markets, then we have far bigger things to worry about. And if that requires intervention, then intervene, right?
Yeah, this is the sort of the unknown counterfactual, that they've been saying this since the GFC. What we did was probably extreme, but if we hadn't done it, it would have been worse. And you never know if that's true or not because the counterfactual is never tested. To the extent that governments have been empowered in the last 15 years since the GFC to get involved in capital markets, you do have to live with it and
Yeah.
not to fight the Fed.
Don't fight the Fed. Don't try and guess what they're doing either, to
Mm,
a certain extent.
mm, mm,
So, what what does it look like and feel like from a fund manager's perspective? So, and I kind of want to just talk a little bit about SALT because I think, originally came on my radar because I read one of these papers that you guys put out recently, the SALT Global Outlook for October 22. Really good read. And you know it's going to be a good read when the first headline says, "This is going to hurt." So,
Nothing if not honest. Yeah.
nothing if not honest.
Yeah.
But tell me a little bit about SALT. I know that, correct me if I'm wrong, but I think it's been around for about almost 10 years, right? And
Yeah, just
you're,
over. Okay, SALT was originally started as New Zealand equities only, and it had large institutional mandates. So for that reason, it hasn't always had the retail name recognition that other fund managers have had. It's a specialist in equities. It's not a bond shop at all. And it's also a specialist in alternatives. And that's what's developed in about the last 4 or 5 years. So one alternative, probably the first one introduced in SALT, was a long short fund. So an equity market neutral fund. The second was the carbon fund, the CO2 fund. So those are good diversifiers that we're building on. When I came on board, wanted to build multi-asset portfolios that did involve some international asset classes, which is where my expertise is. However, we were well aware that bonds were an accident waiting to happen at that point. So while we did build bonds into the strategic asset allocations, they were held at very, very low weightings indeed. This has paid off. The point we're at now is actually the point at which maybe 2/3 of the merit of that position has been realized already. And so it would be time to close up some of those very aggressive underweights that we've had in the bond markets. Not to say that we're newly in love with bonds, but rather that it was about preserving the investor's capital rather than hazarding it. And you could just see a train wreck, a slow motion train wreck coming. Some of the more passive asset managers around town, it's not that they didn't want to do anything, they couldn't do anything because they'd committed. That was a risk lowering asset class. And it's kind of slashed 7 to 8% out of their investors' returns for the year.
yeah. Is that really is that kind of really like an amazing example of just how, if you get really wedded to an idea or a methodology or paradigm, inevitably, given a long enough time frame, it's going to bite you in the backside, isn't it?
Yeah. You can't build an automaton to make you rich. You can't build a machine that can follow certain rules and signals. And the industry tried to because it's cost effective. Eventually, either someone will come in and arbitrage it, so we'll work a way of trading around it. But more likely, actually, what's going to happen is something in the bigger atmosphere environment will change radically, and your machine that you've built won't even notice, and will just plow on making those automatic decisions and dig a deeper hole. So no, you've really got to have human beings actively engaged all the time at the advisor as well as at the portfolio manager level.
It's such a weird tension between two opposing ideas where we know that technology is getting better and better and better, and maybe with artificial intelligence and quantum computing, maybe a passive investment strategy could deliver outperformance for a season until their efficient market hypothesis bites them in their rear end.
I've always thought about that exact example because if you have a thought experiment, imagine everyone in the world had passive holdings and they were all governed by AI decision making. Ultimately, all the AI algorithms would agree on the same price for everything. They would go through a trial and error process and they'd all come to the same price for every security, at which point it would grind to a halt. You'd have absolute stasis. So then what you'd have to do is introduce an error into the algorithm or a random term that meant that they disagreed on that price to simulate the human mind, which would it'd be it's a fascinating, it's almost a sci-fi concept.
Probably where the active fund manager feeds the passive and the passive feeds the active, right? Because they know kind of this difference of strategy creates a circular system, doesn't it?
Yes, it does. I mean, and the thing about passive is it extracts its advantages over the long term because you're just getting that cumulative benefit of cost efficiencies. But over shorter terms, the danger is in bull markets, people think it's magical. In bear markets, they think it's monstrous. People will always trade at the wrong point if they're not well advised.
So just thinking now in terms of one of the big questions I'm trying to ask everybody I'm talking to at the moment is if you could just think of two things that you learned from the year that we're currently in, and maybe two things about the year that's to come. Love you to share it. So what are some of the two things that you kind of learned from 2022 so far that you think will inform your investment decisions next year, Greg?
I think one of the big lessons is that you cannot just assume what the central banks tell you is going to happen will happen. I think people make the mistake of thinking, because they have so many economists and so many analysts, that they can almost make a track happen, whether it be GDP or inflation or wage settlements, whatever. Too much trust in those official agencies is unwise, because I've seen recent evidence that they've been way wide of the mark. So make your own decisions. Don't trust a track laid out by any agency. And secondly, from this year, I think probably remember the time horizon. Remember, we're in really special times, that we're unwinding a period of huge monetary stimulus that was unprecedented. There was never that much money pumped into the world economy as happened in 2020. All the old monetarists, the Friedmans of this world, all the people who were around in the early 80s would tell you that was going to have some dire consequences. And we probably haven't worked through them yet. So just be very, very careful, because when risk is cheap, a lot of things get way overvalued. Now they're in the process of selectively devaluing. I don't want to name names, but look at Meta, Facebook. It's a stock that had a good growth story for many years, but it's run into a credibility problem and a strategy problem, and it's been tagged as one of the victims of this reallocation of capital away from social media. And yet, at the same time, people are ever more reliant on social media for trading signals. I would remind people that a lot of stuff that you see on social media, and this is for next year as well, it's a lesson, been tested to exhaustion in the capital markets over the last 20 or 30 years. I'm thinking here with technical analysis, for instance. And just because they're on social media doesn't give them a new lease of validity. It's just because they haven't been tested yet.
That's a really good point, Greg. And I guess that's a lesson to anybody who kind of follows finfluencers online, right? Like you're not necessarily listening to something that hasn't already been tested. It might be new to you, but it's not new to the markets, right?
No, and you see that totally in the NFT space and all of those assets that kind of got launched on. You've got to separate. I think the big lesson for next year is, yes, there are Ponzi systems operating around the world, and they can get very big and they can look very compelling. But any Ponzi system is only as good as its last investor, and if that last investor has a better option and a safer asset, they'll take it. And then the whole thing can unwind quite quickly.
So the trick is to choose the Ponzi scheme that you feel is most appropriate for your investment time horizon, right?
We're not meant to recommend any sort of Ponzi schemes.
Well, some would say mainstream investing is the biggest Ponzi scheme ever, right? So
you have to
there's
identify
that.
the one that you're comfortable with. Indeed, it's quite true.
No, that's awesome. Now, if people want to follow you, Greg, if they want to learn more about SALT, where would you recommend they go?
Okay, we've got our own website, saltfunds.co.nz. We have a LinkedIn page, so Salt Funds Management on LinkedIn. All of our new updates, short statements, video links, which are weekly, are on that LinkedIn page as well.
That's awesome. Awesome. Well, thank you very much, Greg. Really appreciate your time. You've been very generous spending this time with me and helping me to understand this space. Hopefully our audience has really got a lot out of it as well. So thanks again.
Pleasure.